Bloomberg Audio Studios.
Podcasts, radio, news.
Good afternoon. For our audience worldwide, welcome to the program, a special edition of Bloomberg Surveillance on a Federal Reserve decision. The decision as follows: a 50 basis point cut with a sprinkle of dissent. Your equity market on the S&P 500 still just about firmer, but rolling over in that news conference. We're now firmer by just 0.25%. On the Russell, still elevated up by more than 1 full percentage point. Straight out of the gate in that news conference, framing policy recalibration, something he said multiple times, a process that evolves over time. Take a listen to what the chairman had to say on the path forward.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the S&P. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate.
Recalibration on repeat. Lisa, looking forward, meeting by meeting, this is not the new pace. That's something he put some weight on, some emphasis in that news conference.
And if you were basically judging his news conference based on the stock reaction, there was a little wobble after that statement, and even more of a wobble after he really addressed the idea of a neutral rate. He called it a sense of neutral, whatever that may be. And he said that my own sense is we're not going back to that Nehru time or that negative rate, very low rate time. Neutral rate is probably much higher. You saw a reaction there, but then people shook it off and said, hey, he's got our back.
I look, John, I strapped a Fibonacci across this, and from where we were to the midpoint of the pandemic low is 2 7/8. He is correct. It's just a nudge in the distance to travel just to get back to the midpoint, call it normal. It's a lot longer than the jawboning in the press conference that we just saw.
We're lucky to have Mohammed alongside us. He won't say mission accomplished. He refused to say it in this news conference, but we've got to ask, isn't it implied? Listen to this. The labour market conditions are pretty close to maximum employment. Retail sales, GDP show the economy is growing at a solid pace. We're not seeing rising layoffs or hearing it from companies. It's time to support the labour market when it's strong. That's what we're trying to do. Is that mission accomplished? Isn't it implied?
Yeah, I mean, Jason Furman put it as well as anybody can when he said, if you look at the projection, and now if you listen to the statement, it is, and I'm quoting him, just about the closest thing to mission accomplished banner that you can imagine them unfurling. So I think it is. The hard thing for Powell is that we're not just recalibrating policy, we're recalibrating what we mean by a 50 basis point cut. You don't start a 50 basis point cycle with a 50 basis point cut and say at the same time the economy is in a good place. And that's what he had to navigate all the time. If the economy is in a good place, why are you starting with 50 basis points? And it was harder for him to reconcile the two because he didn't want to acknowledge that keeping rates unchanged in July was a mistake. So that's the tension that played throughout the press conference.
He did mention that if they had that jobs report before that meeting in July, that maybe they would have gone 25 at that meeting. What did you make of that?
I made of that this idea that what does he mean about the totality of data? And he didn't talk about data dependency in quite the same way. When he was asked by our own Michael McKee about what he was looking for and how much he seems to be reconciling something, he didn't have a really clear view on that. What is the data we're looking at now? Is it basically revisions to the jobs numbers that we're getting, as well as potentially the beige book?
You've said this a few times, revisions. Seems to be more weight now in revisions. And I think over the last few news conferences now, he's basically said whatever payrolls is, he thinks it's overstating jobs growth in this country.
Which has been just the truth over the past couple of months and frankly more than a year. Typically, when you get a weakening labor market, the data that you get initially is stronger than what you get on the revisions downward. But just to build on the idea of mission accomplished, he kept saying that the only reason he could really make a commitment to 50 basis points is we are committed to coming up with a good outcome. He came up with he went to the thesaurus about soft landing, but that was really where he was heading.
Joining us now to discuss to continue the conversation, Bill Dudley, the former New York Fed president and Bloomberg Economics senior advisor. Bill, in your piece before this decision on Bloomberg Opinion, you said the Fed should go big now. I think it will. It did. What did you think of what you heard this afternoon?
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is, how do you do 50 without scaring people that you know something bad about the economy? And I think he did that very well. He basically said, we're doing this because the news is good. We've made progress on inflation, as opposed to we're doing this because the news is bad. So I thought it was a very, he's providing reassurance to people that Fed thinks that they've got it. Also, when he's asked about the Somm rule and the risk that the unemployment rate could go up by quite a bit more, pretty reassuring on that. Thinks that the labor market can stabilize close to where we are today, and that's really hugely important, because if the labor market doesn't stabilize, then we will have a mild recession, and then the Fed will have to ease a lot more. So I thought the general tone of the press conference and the statement was, we've got that. We've got it.
Bill, congratulations. Your essay today, you think you were one of the Fed whisperers everybody's talking about out there right now. Bill Dudley, I look at where we are and where we're heading, and it simply comes down to the strength of the American economy. Forgetting about the theater of recession, where does GDP settle? Whether real GDP or nominal GDP, how do you envision that in a year or even 2 years?
I think if you look at the Fed's forecast and look at how that growth affects the unemployment rate, the Fed thinks that, growth in the medium term is going to be 2% plus at an annual average rate. So, and that's sort of what we're doing right now. So, the Fed's got a sort of soft landing in place. If the economy continues to grow at the same pace as it's doing right now, the unemployment rate will stay relatively stable. You saw in the summary of economic projections, the Fed shows a very modest further increase in the unemployment rate from 4.2 today to 4.4%, but nothing beyond that. So it's sort of a soft, if you look at their forecast, it's a soft landing kind of story, and I hope they could pull it off.
Right now, the stock market and the bond market are trying to understand what the reaction function of the Federal Reserve actually is and to which data they're going to look at. It seemed like there was a renewed focus on both jobs revisions as well as the Beige Book, which was the input to potentially some of the heavier weight on 50 basis points. Do you view that now, as sort of these data points as taking on outsized importance?
I think they are more focused on the labor market because there has been deterioration in the labor market. I think they're much more confident that inflation is going to continue to come down because they've seen, more slack in the economy and the labor market. They've seen, inflation progress that we've already had. They've seen wage inflation moderating. So I think their concerns are very much on the labor market side. So when I'm looking at the economic data right now, I'm really focused on the labor market data, and that will determine whether we just continue at a relatively modest pace after this of 25 basis point reductions, which is essentially what was implied in the summary of economic projections, or whether they'll become more concerned about downside risk, and then we'll have to throw in a few 50s.
Bill, congratulations both on what you said they should do and what you said they would do. And part of your argument was on the unemployment rate. So I want to go back to that. The revision up to 4.4% by the end of this year, stays at 4.4% at the end of 2025. Are you comfortable that we can stabilize here without the tipping points that you were so worried about?
We're going to find out over the next year. I mean, the Somm rule is a very simple, tells a very simple story. When the unemployment rises beyond a certain threshold, the next stop is a full-blown recession. The question is, what's the right threshold? Historically, the Somm rule threshold has been a 0.5 point rise in the unemployment rate on a 3-month moving average basis over a 12-month period, and we've already pierced that threshold. So you have to believe that there is some risk here. Powell was asked about the risk and downside risk to the labor market, and he sort of mostly dismissed that. But I do think that I actually do think the risks are maybe at best they're balanced, but I would actually be more concerned about the downside risk to the labor market now than the upside risk to inflation.
Bill, you'll always find a politician that's unhappy. I've found one. Senator Warren. This cut in interest rates is yet another acknowledgement that Powell waited too long to reduce interest rates. I do think the politics are relevant here. November 7th will be the next meeting. We might have a decision in hand by the American public as to who they'd like the next president of the United States to be. We might know the makeup of Congress as well. We might have a better idea of what policy looks like in 2025. Bill, you've lived this. You were on the FOMC back in 2016, I believe. Can you walk me through your experience back then and whether the same applies this time around?
I would be very surprised if the election outcome affected what the Fed does over the near term, because, you know, an election outcome is one thing, but what the incoming president will be able to do with, you know, a closely divided Congress remains very uncertain. And so I think the Fed reacts to the world as it is, as opposed to speculates about how the world could be. So I would be very surprised if the Fed doesn't cut rates at the November meeting. I mean, if they don't cut rates at the November meeting, it's because the economy is bounced back and very strong, or the inflation news is, you know, really bad between now and then. And that's not something I expect at this point. I don't think that Powell expects it. I think, you know, the odds of a 25 basis point rate cut in November are very, very high. And, you know, if the economy shows, you know, more weakness, then maybe even 50 basis points.
Hey, Bill, appreciate it as always. Bill Dudley of Bloomberg Opinion. The Fed should go big now. I think it will. It did. It did about an hour and 30 minutes ago. Let's bring in Michael McKee. He was in the news conference. Mike McKee, I want your thoughts on that press conference, where there was a little bit of tension for you. How did you walk out of this one?
Well, I don't think there was a huge amount of tension, except for the fact that, as you were just talking about with Bill Dudley, the idea that there is probably more risk to the Labor Department, to the labor market, than the Fed is letting on. And that's the concern. And to get to my question that Lisa mentioned, the Fed was data dependent until they were confident that inflation was going to be down to target. But how can they be data dependent on the unemployment rate? We don't know what it's going to be. And as Bill suggested, it could go up rapidly. Do we get a rapid response then, especially since policy works with a lag? It's a little unclear what their reaction function is going to be going forward.
Mike, looking forward to catching up with you tomorrow. Lots to talk about. Plenty more data just in the next week or so. Equities right now on the S&P, Lisa, firmer by 0.4%. The outperformance on the small caps, as you might expect.
Yeah, and the Fed basically gave this market what it was looking for and then some. A question now of just how much this market has moved ahead of what the Fed has said. Mohammed, I would love your thoughts on what the new data dependency actually is, given the fact that people are looking for a litmus test to understand what the reaction function is of a Fed that kind of is playing with what they get, which is the same lack of clarity that we have.
Yeah, I think the data dependence all comes down to the labor market. And he went through in detail a number of indicators he looks at. And when he says the totality of the data, I think he really means it when it comes to the labor market. Lisa, I'm surprised you haven't picked up on the fixed income market and what has happened to treasuries, that they're now higher on the day. There's been quite a move. When the statement was announced, the 10-year went down to 364. It's currently trading at 370.
It's up 6 basis points.
It's up 6 basis points.
What do you think that is?
I think that there is some, and the curve has steepened. 2s10s are now 9 basis points. I think there is some concern as what does it mean longer term for inflation. That's the only thing I can think of. But the action has been really interesting. And once again, you end up in a different place after the press conference than you were after the statement.
Yes, no question about that. I think of David Kelly at JP Morgan. You know, John, he's been very good about a vector of non-farm payrolls that gets you to a negative statistic. 3-month moving average, about 116,000. Nobody's modeling in here if this job economy, as Anna Wong talks about, continues to deteriorate.
So what are we saying here, Mohammed? We're willing to accept 3, the high 2s, or we're worried about going back to 3.5, pushing 4? What's the story here?
So we cannot answer that story without bringing in fiscal policy, without bringing in structural reforms. I mean, that's the trap we have all fallen into, that we still think of the Fed as the only game in town, but there's other things happening that speak to what is that rate. And that's why the range is so wide.
You brought this up, actually, when Jay Powell said this. Over time, and we're going to get down to 2% over time. It raises this question, especially as he talks about not mission accomplished, but sort of, you know, wish and a washed, but this idea that maybe we could end up with some
I'm not going to ask you to say that again.
Please don't ever do that again.
I won't.
No, but this idea that, you know, he's so excited about the idea of a soft landing that it will it's okay for it to take a number of years to get back to that 2% target.
And that's in the projections. I mean, I have him in front of me. He said core PCE right now is 2.7. They're projected at 2.6 at the end of this year, 2.2 at the end of next year, and 2 by 2026. We've basically pushed back the target.
I like what you said about mission accomplished, and it's this terror of getting this wrong, whether you're a governor, a president, whether you're the chairman. Jason Furman out teaching Act 10 up at Harvard, and he was lectured by his daughter, John. We got a tweet out from Jason Furman where his daughter walked in and said to Professor Furman, "You were wrong." There's a lot of that going on right now.
A lot of people were wrong. I think we should point this out. The market was priced for something closer to 50 than 25. The overwhelming majority of economists in our survey, and we surveyed more than 100, not even 10% of them saw 50. So shout out Mike Ferroli over at JP Morgan, one of the very few, together with Anna Wong, I believe, over at Bloomberg Economics, who were looking for that 50 today.
Yeah, Deutsche Bank actually did an informal survey also that they put out today, and something like 61%, roughly, plus or minus 0.5%, came out saying that it was 25 basis points. So this really was kind of on the back foot.
I kept it quiet. Nobody cares what I think, but the fact is I was wrong.
Jeff Rosenberg of BlackRock joins us now for more. He wasn't wrong. He's been waiting patiently to give us his views on this. Jeff, let's talk about the bond market, and you can throw in your thoughts on this Federal Reserve decision, the projections and the news conference as well. The bond market's selling off. The 30-year's up 7 basis points. The 10-year is up 6. What do you think that signals, Jeff?
Yeah, I think the important point here is that there's the action and the 50 basis points, and then there's the expectation and what was priced in. And so while the bond market was leaning towards the 50 basis points, it was really more about that segment, Jonathan, of the press conference that you highlighted. I had it written in my notes as well. The interchange where Powell said, don't take that 50 basis points as the new, pace. And he pushed back against, this is going to be followed by, he got several questions on more 50s. The problem, and I think to answer a bit of Mohammed's question, your question to Mohammed in that interchange, is that the bond market was pricing in more subsequent 50s, and into 2025 still is pricing in bigger increases than what you're getting in the S&P. And Powell in the press conference really pushed back against that. So I think you have two things going on. I'm very amenable to Mohammed and Lisa's comments that maybe this is a little bit of a sign of inflation and some of those concerns, what you're seeing in gold. But it's also, I think, in the immediacy, this is a little bit disappointing relative to what's been built up in bond expectations. And that, from a broader perspective, is really an important point from an investment perspective that you can have. Here's the headline. Fed cuts interest rates by 50 basis points and the bond market returns are going to be negative today. So it's not just, the action I can anticipate, the Fed's cutting rates. It's time to back up the truck in terms of duration. The problem is it's also a lot in the price. So they've got to over-deliver, and they didn't do that relative to bond expectations. And that's why I think you're seeing a little bit of that disappointment out of fixed income markets and their read on today's decision.
Jeff, Mohammed schooled me because, frankly, I wasn't paying enough attention to the bond market. The bond market is speaking, and the 10-year note is speaking. And what it's saying is it at least has a higher yield. But we are speaking to the bond market right now. Jeff Rosenberg, what is your reaction function? Does this make you less interested on the margins in buying 10-year or 20-year or 30-year treasuries?
Yeah, I've said in lots of different contexts with you guys that you have to just be careful about where you want to own your fixed income, that the yield curve move can be more important, more determinant to your fixed income returns than just the direction of interest rates. A lot of times we just think about you want to own bonds when rates are going down, when the Fed's cutting. You don't want to own bonds when they're hiking. But because the curve is so flat, we're off the peak of inversions, but it's still a historic lack of premium in that back end of the curve, that where you hold your duration is going to matter as much as how much duration you hold. So it's still that story for me. It's still the front end is a little bit better 5 years and in. You want to be careful about that term premium. And the other thing that I'm highlighting here today is you just got to be careful about how much is already priced in. This is unique about the beginning of a Fed cutting cycle. We're about twice the amount of expected cuts priced at the onset. This was John Otter's article in Bloomberg. He highlighted this. It's a great chart. About twice the amount of historic Fed pricing, about over 200 basis points, whereas historically you come in and there's only about 100 basis points. So a lot is expected. It raises the bar for subsequent fixed income performance. We've had a great run, but that tells you a lot of the performance is in the rearview mirror. And so you got to be more thoughtful about where you own that duration around the curve when we look forward.
Does it give you more confidence, though, to go into risk, Jeff?
Well, I think the Fed did its best, and that was the interchange you just had with Dudley. The press conference challenge was give 50 without spooking the market. I think they're successful today in there. That's the response in terms of small caps. You only buy small caps when the Fed's cutting rates, when you believe in the soft landing and the denominator effect. The discount rate is dominating, any of your concerns in terms of growth. So I think they navigated that pretty well. I think when you go forward, it is a soft landing baseline. I think that's exactly what the SEP is saying. When you look at all of the other economic data outside of the labor market data, it's all very good. It's all very supportive for risky assets. And the fixed income side, that's a carry story. We're pretty comfortable with that. You got to be a little bit careful that it's asymmetric, that at very tight spreads, any sign of recession. And I don't think we're really seeing the recessionary signs out of the labor markets. But you have to be cognizant of it that is the one place where you're seeing some weakness. But I think this is still supportive to risky assets.
Just quickly, Jeff, November 7th, how different is that committee meeting going to be compared to this one?
Well, as you pointed out, you're coming on the backside of the election, but as Powell answered, they're going to try to avoid any kind of discussion on that. It's really going to be about the evolution of the data. The interesting data point in terms of revisions. We talk about data dependence. The problem is the data we're dependent on is not very dependable. All right, try that out slowly. But that's the payroll data, right? And so the revisions are going to be important. We're going to have another one. That's going to dictate a lot of the discussion. Without a deceleration, I don't think you're going to be talking about 50s, but they've clearly laid the groundwork here for a 25 in November, 25 in December. That's what I think will price back into the bond market. That's why you're seeing a little bit higher rates. If they deliver on that, then there won't be as much surprise or anticipation as we had in this meeting.
So, Jeff, let me ask the question that I suspect you hate being asked. And let's assume that you're being asked for a retail investor 60-40 simple portfolio. What should they do now, given everything you've just said?
Yeah, I mean, the part of this discussion around the 40, around the fixed income piece, Mohammed, is that it's not the old 60-40. It's not this era where bond volatility is 3%. Bond volatility is 6 to 8% in the post-COVID environment. So the 40 side is really where we've got to do some rethinking. And that's where we talk about diversifying your diversifiers, thinking about different ways of finding ballast in your portfolio because of the uncertainty of how duration and risk-free rates are going to perform in a more inflation uncertain environment. That's the points about the yield curve and what's already priced in. So I think in that 60-40, it's really about using different ways to find diversification and diversifying that 40 bucket away from kind of just piling into traditional duration.
Did I hear you say a more inflation uncertain environment?
That is what I said, yes.
I don't think that's what Powell thinks.
There's greater confidence that inflation is on a path to returning to 2%, but we're not at 2%. And that path, as we saw in the interchange, the shelter inflation, the uncertainty around how far we're going, and the wage inflation picture, right? There's a lot of confidence that we're moving towards there, but we're not quite there yet. That's the point about a more uncertain inflationary environment. And with respect to kind of negative stock bond correlation, which is really the driver of the 60-40 part. The challenge is that was really working well in your portfolio when inflation was missing from below. Inflation is still missing from above. And until you get back to the period where we have too little inflation, you're not really back to that halcyon days of fixed income and 60-40.
Jeff, this was perfect. Thank you, sir. Jeff Rosenberg there of BlackRock on the Federal Reserve decision. If you are just joining us, welcome to the program. It's a 50 basis point cut from the Federal Reserve with some dissent. The first dissent we've seen from a sitting governor on the FOMC going all the way back to 2005. Governor Mickey Bowman, not a surprise for many of you who've followed some of those speeches over the last month or so. If you're looking at the equity market, just about attempting to hold on to an eighth day of gains on the S&P 500, and it's a struggle. We turned slightly negative on the S&P. On the Nasdaq 100, we're negative by 0.05%. Mohammed, just a final thought. What I heard from you then, if you have any confidence the inflation story is done, that we're on a one-way trip now back to neutral, which might be around 3%, are you suggesting that confidence might be misplaced?
I think it's too early to declare mission accomplished. We've come a long way. but there are inherent contradictions that still have to be sorted. John, this was historic. I mean, we're going to look back on this day not only as the beginning of the cutting cycle, but as having recalibrated what we mean by 50 basis point start to a cutting cycle. And we're going to look back, and either this will be the absolutely right bet, which is be preemptive on the labor market after you are reactive to inflation. This is a fundamental change in the reaction function. Or alternatively, we will look at this as being too aggressive. I'm hoping that it will be the first, because we all want the labor market to do well.
Of course, Michael McKee asked him about being preemptive, and he said data dependency or the totality of data. My big issue coming out of this is, do we understand the Fed's reaction function more, or do we understand it less than we did before?
I think we've got a lot of questions that still demand answers, and hopefully we'll get them over the next few weeks, but I doubt it. Once that data starts to come in, I'm looking forward to hearing from the rest of the committee, aren't you?
Oh, yeah.
Over the next few days.
There's quiet dissents.
Yeah. Let's just see how close some of them were to actually going 25 and not the 50. Mohammed, thank you.